I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
We're chatting with market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
Credit spreads are no longer narrowing. Does that mean that they're getting wider again?
Not quite yet, turn to that, Jim, but you had last year with the crude oil price coming down, and it crashed down into January, and of course a fair amount of bond issues out there were related to the petroleum business, and so junk bonds got tanked, just hit very hard. And then relative to treasuries, the spread was widening, and it got out to over 20% by the time it finished, I think, in January there. And then you had the relief bound out of there, and then it's just kept going. It's become, a movement unto itself of narrowing credit spreads until, a week ago. And it's just been sideways since then, so you can't say there's a trend change. But what has changed is that the yield curve, the difference between short-dated and long-dated treasuries, has been flattening with, well, you can't say the economic boom, but you can certainly say with the financial boom. And then came in, and we've noticed in the past that this flattening, if you're in a really big economic boom, the curve can go inverted. So, but this time it just flattened down, and it's turned very dramatic in the last week and a half of turning to steepening, and this is indicating a big change in the credit markets. Now, we were onto this in May of 2007. And the curve had fully reversed in May of that year. And then in June, it was followed by credit spreads changing. And early June, you had the announcement of the Bear Stearns financial pressure default insolvency problem. And then that started that whole contraction, which then became ugly. But it was in early June when I was at London at a conference thing, and the presentation included PowerPoint, and one of the PowerPoints was a image of a train wreck, and one was sort of an amusing train wreck, and then the other was a disastrous train wreck. And this we said that the world's credit markets had begun what could be called the greatest train wreck in the history of financial markets, which it did turn out to be. So here we are now. Similar change, and with the curve has changed, as I said, dramatically, and now we just wait and watch for the spreads to turn to widening. So it's not healthy, and it's also pushed off some concerns in Europe with the Deutsche Bank stock dropping something like 10% today. Mind you, there was something about the U.S. government and trying to get some fine money out of the bank on some previous, I don't know whether it was a hoped up malfeasance or not, but a lot of these struggles, and huge fines are really just ambitious government transferring wealth from the private sector into their public sector, so-called public sector. So, but at any rate, it's then pushed another leg down here in the stock market, and it's not looking good. When you September, you can markets, if they've been inflated, which the stock market has been, they can head down in September, and then in October, all of a sudden, you can get a whole rush of bad news, maybe below the horizon stuff where suddenly somebody has defaulted. Like a couple of weeks ago, it was the huge South Korean shipping company, container shipping company, and I was just reading one in the Vancouver paper here this morning. There's 2 of their ships have been seized and are being held, one just off of Victoria and another one off of, I think, Rupert. So it's amazing how something in Asia, suddenly you see the evidence of it more at home. So it doesn't look very good, I hate to say it.
Well, the claim by the U.S. Justice Department, $14 billion against Deutsche Bank for alleged shoddily backed mortgage deals in the U.S. through that bank. The Deutsche Bank says it will fight. It seems to me banks are relying more and more on illegal practices to make money. You have Wells Fargo fined $185 million for churning people's accounts they didn't even know they had, so they could charge you NSF fees.
Oh, that Wells Fargo thing. They had, there was incentives throughout the whole system to open new accounts, so they were opening up dummy accounts. And then it's, how can, I don't know how a company can have greater policing, but I think also part of the game, as like in the case of Deutsche Bank and businesses they were doing in the insane housing boom in 2006, that there's a lot of these regulations are put in to create criminal acts so that the state can gather in fines. I'm a bit of a libertarian on this side, but the one by Wells Fargo is of course, it just is shoddy business practice. And then I remember part of the headline story was that the guy who headed up that division retired with over $100 million or something on settlement stuff. So, no, the financial side of business is, it's insane. It's all part of a bubble thing when anybody thinks they can do anything. And often cases, the government goes along with it while it's on because they like all the revenues coming in. But notice that the thing with Deutsche Bank is geared to practices that were done in the 2006 housing bubble. So, it doesn't put a good light on the financial markets when participants are abusing the markets. But then you have yet other participants like the central bank also abusing the credit markets because they have, for 100 years now, had a theory that if you prevent problems on the financial side, you'll prevent a bear market in stocks, and then you'll prevent a recession. Well, there's been 19 recessions, and who knows how many bear markets since the Fed started in 1914. So there are very serious abuses going on in the financial markets. But it's also part of it is the absolutely reckless behavior by central banks in trying to prove a theory that they can manage an economy, which has always been absurd. And then you have, like with the Democrats and Hillary Clinton, their candidate, who is locked into Wall Street. And of course, Wall Street is going to support whatever party is going to allow the no constraints. So actually all of this is sort of burning out in here now. I think and of course it goes around again. I just thought one more layer on this, Jim, where the state in its ambition to grow needs a perpetual motion funding machine. And it has raised tax rates to the point where people can't tolerate any more increases. And then that's inadequate to their ambition, so then they depreciate the currency, float huge amounts of debt, and so it has been on for many decades, and I call it the perpetual motion financial bubble to keep the state going. So if this bubble fails, which I believe it is, it's going to impair the ability of ambitious people within government to continue their programs. So maybe one wants to look at what happened in Russia and Eastern Germany when communism collapsed at the end of 1989. What happened to all their state-run pensions and government enterprises and all that sort of stuff, you know? Who knows? But the system is not healthy. You have corrupt federal government. You have a corrupt central bank. And in the U.S., you have a corrupt IRS, Internal Revenue Agency, which is involved in promoting the Democrats in the election. So there's corruption all over the place. So I think a major, another phase of financial contraction will make the whole system a whole lot more honest. It'll be uncomfortable for participants, but we have been calling for a resumption or a major decline in stock markets. This now is becoming like it's going to happen. In July we had the upside exhaustion movement in the long-dated treasuries or long-dated Canadas, and the advice was to shorten term and traders to start to play the short side, and the long bond is now off about 10 points. And the one item that in July we thought could continue in the play for a bit would have been low-grade securities, and that's happened, but now we'd be out of those as well. Stormy weather out there. I think the one here we were talking about a bit was the crude oil. It's weaker again. It's down into the 43s. And I think it go right back down to that and back into the 20s again. And again, we're going to remind ourselves that crude oil can often have a low seasonally in December or January. And that is an unpleasant prospect. But also copper, its seasonality is it can have a low sort of November, December. And actually the way it worked last year, they both had lows in the same month. So why am I being so bleak? Because the financial markets are failing, and one has to report what one sees.
We'll have more with Bob Hoye right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're chatting with Bob Hoye. Bob, what kind of pressure is there on the banks from the downturn in oil? All those big loans they put out for people to look for oil, I guess they're becoming due now.
Oh, yeah. It is very tough to service debt. Well, let's back it up for a minute, Jim. It is very easy to take on debt in a boom when things are going up. And, of course, the price of crude went up and up and up until the secondary high at the sort of 107 level a couple of years ago, and then it went down to 26. So this is tough for anybody in the business, and but it's like the in agricultural prices, they set new lows for corn and corn and wheat recently, and blessed major growing areas have had some good weather, but you still have weak prices, and so that prompts the farmers to go out, and as the saying is, you plant from fence post to fence post, because you got to grow more to get maintain your revenues in weak pricing. And so the same is happening with in the crude oil business. With fracking, you can turn things on and off in an instant, and so this then is driving the prices lower, and so the Saudis and OPEC talk about diminishing their output in order to put prices up, which they make less money with, But I think they're all going to be so eager for money, and Saudi's in debt now, so that they're going to be, fence post to fence post, same sort of thing. You got to produce as much as you can. So it's a grinder. We're in a post-bubble contraction, the bubble having concluded in 2007, where the crash ended in 2009. So this is the first expansion out of a classic financial bubble and crash, and it's now getting tired. And the financial markets, you had the senior indexes in the U.S. set new highs a month ago, but if you take a look at the broad market in the New York Stock Exchange, the NYA, it did not make new highs, as did the transports. And you go back a year ago when we noted all through the first half of 2015 that while the Dow was making new highs and the S&P making new highs, the transports weren't. And for the first time we ever used it was to fall back on the old Dow theory. And by May, that transports had made new lows, so it called for the end of the bull market last year. And then this year, on the rebound, if you were after the Brexit disaster, the central banks around the world started buying stocks like crazy, which would include the big U.S. stocks, because they have to buy the most liquid ones. So that would be the S&P 500. So these made new highs, but the broad market didn't, because the central banks can't buy the broad market, and it's now failing. So we're in a position where it's going to be interesting as this bear market evolves. The central banker is going to be long a lot of stock that is going to be embarrassing to hold. So we live in very interesting times.
Well, consumers certainly haven't benefited from the drop in commodity prices. Oil prices dropped 70%. Airlines dropped their price 2%. Take a look at the cost of a box of cereal in the supermarket. It certainly doesn't reflect the low cost of the grain it's made from.
Yep, not yet, but it'll eventually filter through. Not that the price of a box of cereal is going to drop hugely. It's just that it'll, I think, there's got to be some competition come through. And the highs for the grains were in 2011, and so it's quite a lengthy decline. And as I say, corn and wheat making new lows within the last 4 weeks. So maybe a full-fledged recession where people are actually believing they're in a recession, and wholesalers and retailers realize they're in a recession, and then I think you'll get some price cuts.
Bob, thank you so much for chatting with us.
Hey, Jim. Always good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions to info@HowStreet.com. Bob loves to answer those questions, by the way. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.